Good morning and welcome to Stock Investing in the month of August. The welcome from the market is all not that warm. It's a pretty good sell-off that we've got going here in day one of trading in the month of August. We've got some big names down substantially. We got Amazon is down. They reported, and I do believe their cloud number was a little light. It was 17.5 growth rate, and the growth for Azure, which is maybe their closest competitor in that space. Amazon's still the number one player. Azure grew much better, and maybe the market's having trouble with that. So I thought we'd take a look at Amazon today, kind of dissect that stock, make sure that we're not missing anything in that stock. And the sell-off is not just isolated Amazon. NVIDIA is down. That's been a super successful stock in the stock market this year, and it's down a little bit. Broadcom is down. AMD is down. So the semiconductor space is down. Looks like Doomy Trash is on. Hope you all safe in days like this. Well, safe would be in healthcare. Healthcare is kind of keeping its returns right now. Staples, it's standing up tall today. But these are sectors. Staples, I'm careful with because on days like this, they look great, but most of the time they look terrible if you consider the low appreciation rates and so forth. But yeah, I appreciate the gesture, Doomy Trash. I hope you're having a good day. I hope you had a tremendous July. I had a very good July. I'm having a very good year to date. This volatility comes to the territory. And this is bad news, good news. Bad news essentially is we're going to have a sell-off that's a pretty good one. The good news is maybe that company or set of companies that you think are just terrific, they own a good part of the future industries. We get them at a better price. That's the good news. Doing your research, your homework, valuing companies based on their cash flows, their growth rates, their balance sheets, their profits, sets you up to be in a position to buy those stocks. For example, Meta is trading, I think, above $700 a share now. And in 2022, the market sold off that stock just viciously down to like $85 a share. And investors that had done their homework and bought Meta in those days are just so happy because their investment went up, 8 times their investment. So now that's probably not going to be the situation we're heading towards, but we'll see how prolonged this sell-off is. As I've commented in the weeks leading into this day, stocks were expensive. I don't know that anybody's going to argue with me, and we'll see how far back the market decides to take back these stocks. Looks like Brandon is on. How are you? Yeah, and again, I get your sentiment, which is, I looked at my portfolio and yesterday was a lot funner than today because I have Meta. It was up 11 point something%. That's my biggest position, and it flourished along with some others. But it's the opposite and then some. I mean, it's a big down day for my portfolio, but I'm still up for the year to date. Now, stock investing is a little bit like, just think of that either tough sport, tough journey. Think about mountaineering, marathon running. There's certain periods when it gets tough. If you're, playing a sport, let's say football, since we're coming up on football season, you may be down in the second quarter or the third quarter by a touchdown or two, but it's not a time to kind of give up. It's actually a time to focus on what you ought to be either researching, studying, double check, your calculations, get your mind clear and focus on the companies you want to own. I tend to think that these are the times, especially prolonged sell-offs, when you make a lot of money. You make a lot of money down the road, and so I think we could help each other keep that mindset, that term successful investor mindset. And it's great to have you on the stream. Thanks for your support of the channel, Brandon. And let me know if you would like me to take a look at a particular stock. Braden, it's a good day to buy A-Lab. I agree with you. A-Lab's a high growth semiconductor company, and I think they're going to continue to grow. I can't argue with that. I looked at it earlier today. It was down quite a bit. So I will co-sign that I'll probably buy some A-Lab shares today. Thanks, guys. We've got a lot of people on the stream already. We are active on the stream. Thank you so much. I've got a set of stocks I wanted to go. Most of them announced either yesterday after the market closed or they announced today. But if you have a topic or a stock you want to talk about, put it in the chat. If you're a member, you can put a ticker on there. I will review it. We'll do a deep dive. Not a member, $5 super chat. Now, deep dive analysis on a stock that you would like me to cover. So looking at the heat map, it is an interesting one. Let me hit refresh on this puppy. It looks like stocks are picking themselves up off the mat. They kind of took a couple of good shots in the early innings of this bout and are picking themselves up. So it looks good. It's also really good to see healthcare is doing well today. There was some negative news where the president is asking the healthcare companies to lower drug prices. And that's not something new. That's kind of recycled, kind of activity that usually leaders go to pharma, because a lot of folks that vote are older and they have, prescriptions they have to fill. So they're on these pharmaceutical drugs that help them live more comfortable lives, maybe deal with a particular condition. So when you say you want to lower drug prices, you're speaking to that constituent in your party. Totally get it. Totally get it. And it just comes around just about like every couple of years. Oh, these drug companies got to lower drug prices. And we'll see if it actually has a meaningful impact on drugs or the companies, I should say. So, all right. So moving on from the heat map, I wanted to let's take a look at the earnings. Yesterday we had huge earnings from Apple and Amazon. And if you didn't get a chance to attend the watch party, I was on with Daryl, who does really good technical analysis, and that is recorded and on the channel, so you can view it at your leisure. And Apple announced they had pretty good earnings. They grew their revenue. That was good. Actually surprised me. I've kind of been an Apple bear, just thinking they don't have a strategy for the future. They're just depending on that iPhone too much. But they did improve Apple iPhone sales, as well as their marketplace sales really expanded upwards of 10, 11, 12%. And that's really good for a company the size of Apple's. Amazon had bad earnings. The cloud number looked bad. I'd like to look at Amazon closely. And I thought would be a good exercise is taking a look at Amazon, looking at that cloud business, and going to the competitors, which are Microsoft with Azure and Google with Google Cloud, and seeing what is the size of the business, kind of like look at all three businesses, AWS, Azure, and Google Cloud. What's the growth rate? And then we can split up the share between the three of them, right? Just to kind of get our heads around, we know AWS is number one. They've been number one for a long time, kind of created the space, but are the competitors catching up? And maybe is that what investors are really concerned about? Is Amazon kind of losing market share and are going to be in a battle with Microsoft and Google, two very formidable, competitors. It's not like some obscure little company that is knocking on the door. MasterCard had good earnings. They went up. So those are the big ones that came out yesterday. I think yesterday as well, we saw Coinbase announce, and from what I'm reading on the chat, they're getting hit hard. So look at Coinbase. I'm a Coinbase stockholder, been a stockholder. I'm up 200%. So one bad day is okay. I'd like to analyze the company and see what I think is the true intrinsic value of the company, and I might buy some shares. CBS had really good earnings, terrific earnings. The stock opened in the early hours of trading, and then it faded. The market faded yesterday. We opened up in the green, and then it faded and closed in the red, which kind of telegraphed that, hey, we might have a rough day today. And we certainly are having that rough day. So some good earnings. And this week, we are finishing the big caps with the exception of NVIDIA. NVIDIA reports in a month or a month and a half. But we finished the big ones, starting with Google, Tesla, then Microsoft, Meta, Apple, Amazon. So those are 6 of the top 7. And Tesla may not be one of the top 7 anymore, but it's one of the trillion-dollar market cap companies. So that's some big market cap share of the stock market. So we just finished that yesterday. And where does the market go from here? It's beginning to tell us that we may be selling off, because what next week? No giant company is going to announce next week that could come out and say, like Meta, hey, we're doing great and we're going to do all these fantastic things. Some medium-sized companies are going to come out and they may say that. They may say, hey, we're doing great. We're going to have a phenomenal time, and their stock will rise, but it won't lift the whole market because they're not big enough. So we'll see. So good to see you, Shadow Guy. Song of the day, Through the Fire and Flames. Again, this is like not super alarming. It's going to be a negative week for sure. I'll review that in a little bit, but let's kind of take it in stride. Investing is about, owning great businesses over the long haul and buying them at great prices. If they discount the companies we want to own, what's wrong with that? We'll deploy capital. We'll sit on those stocks, make lots of money. That's the game. This morning, we had 2 big oil companies announce, Exxon and Chevron. And I have not looked at their earnings, but did see an interview with both the Exxon CEO and the Chevron CEO. I was in the gym and I was able to listen to both interviews. And they had some interesting things to say. I'll kind of share that with you when we look at their financials. And some others that were out there, Kimberly-Clark, they're probably having a good day. Vale is that materials company, or maybe the oil company down in Brazil. And those are the big names. So after this week, we're not going to have giant names, but we're still going to have a lot of earnings. So we'll see what happens. So for algorithm, I think Micron technology is decently undervalued right now for a good short-term trade. Yeah, you might be right. The thing I don't like about Micron is their margins. If you study their margins and compare them to, let's say, a NVIDIA or even a Qualcomm or even a Broadcom, their margins are really low because they do the storage, the storage that is deployed with these big servers and GPUs. And it's a good market, but they compete against Samsung and I forgot the other competitor. Their margins are like, gross margins are like 35% or so. And that's what I dislike about Micron. To me, they're less desirable than, let's say, an A-Lab or Broadcom, NVIDIA, and Qualcomm, because those companies have fantastic margins. They get to keep a lot more of their revenue and profits, and they produce more cash flow. But that's one opinion. Make your own decision. Good luck. All right, so let's get cracking. Let's look at some companies and do some work. Exxon is down a little bit. Exxon is the biggest energy company. Back in the day, we used to call them oil companies, but now we call them energy companies. And I tell you that name fits because they are producers of natural gas, and they one second. They produce natural gas, and they're beginning to produce power. They're beginning to buy turbines and serve these customers that are running these big data centers. And these big data centers are obviously needing the power for AI build out. So it's an interesting storyline that the Chevron CEO really went into. If really there, I think it's a really good idea, by the way, because they have the natural gas that fuels those turbines. Exxon has an abundance, Chevron has an abundance. That could be a really neat business for them. So I think they should totally explore that and take advantage of it, because anybody else that wants to do it has to buy the natural gas from Exxon or Chevron or somebody else. And that gives Exxon and Chevron a competitive advantage. So we'll see how that plays out. But that was kind of an interesting storyline. And excuse me. So that out of the Chevron story, but let's take a look at Exxon. Look at their financials real quick. So this is a big market cap, 474 billion. They have a low PE, 15.6. That's a relatively low PE. That's really good. And they pay a nice dividend with 3.6. So those income investors, this isn't a bad proposition for an income investor. The stock has been appreciating a little bit. It's under pressure today. Not a big winner in my book. I'd like to see 15%, annual appreciation at a minimum. And this one here wouldn't be doing the trick. These guys are dependent on commodity prices of that oil price per barrel, as well as the price for natural gas. And those markets have not been helping these big energy companies increase revenue because the commodity price has been low. Over the 1 year, down 7%. Over the 5 year, it's up nicely, 162%. Back in the COVID days, the oil complex was under a lot of pressure because everybody stopped driving. So the per barrel price dropped so much. It was incredible. It was actually price per barrels went negative because they couldn't find enough storage, and that was really weird. But that was where the market was. So from that point, if you bought at that point, boy, you're sitting pretty. You're making that nice dividend, and your stock appreciated nicely. Looking at what they announced, it looks like the energy commodity price is putting downward pressure on their revenues because they actually increased production. They produced more oil, they produced more natural gas, but they didn't get as much for it. The per barrel price dropped, so the revenues as a result went down about 10.7%. They do produce really nice cash flow, so their cash flow is still there, their gross margins are there, and their profits are not as good as previous years, right? They've been up at 10% or so. Now they're down at 8.69. But overall, they'll pay that dividend, and these guys are solid. They have a solid balance sheet. They're going to be around for a long time. And they have the competitive advantage that Exxon and Chevron have is they own the rights to extract oil from certain places of the US as well as abroad. And that gives them exclusive rights to extract the energy from those areas. Nobody else can. Nobody can move in and say, hey, we'd like to extract oil here. Nope, can't do it. Exxon's going to have the rights. Looking at their RSI, they're right there at 50, so neither oversold nor overbought. And this one here, this is a good idea for, again, an income investor. And this is kind of a hedge. If oil prices take off, that usually has a bad effect on other stock prices, like technology prices will go down. A lot of other sectors, discretionary income, consumer discretionary will go down because people just don't have money to buy discretionary items. They're spending a lot of money on energy, gasoline at the gas station, or maybe their energy cost goes up for heating in the winter. So those companies that depend on consumer spend get impacted while the energy companies flourish during times like that. So that is Exxon. On the other side of that is Chevron, and they're up slightly. And Chevron's probably going to have the same kind of revenue decline. They're up about 5%. They pay a nice dividend at 4.5. Again, nice income stock. And this is still not getting it done. Over the 5-year, that's pretty good. 81% plus you got that dividend. So you're up to about 100%. That did get it done. But you can see that over the last 3-4 years, this stock hasn't gone anywhere. It's just been kind of flat because energy prices, oil prices haven't really gone up. We've been enjoying relatively low oil prices, by the way. And we should appreciate that because it enables us to spend less at the gas station and then have money to spend on other things. This company is a big cap, 311 billion, revenue 188 billion. They're underpriced according to the list, and I do have a Exxon that I'll share with you in a few minutes. And I am a stockholder of Chevron. I actually went to work for Chevron my first year at college, and it was actually an oil company that got acquired by Chevron. But really learned a lot from the oil business, and I'm very grateful for the job. These guys, the revenue trailing 12 months is down 3%, but over the last quarter, it went down about 10%, similar to Exxon. And these guys were the ones talking about buying some turbines from GE and putting those turbines, setting up contracts with customers directly, like Google's and Microsoft Azure's and AWS, and installing that equipment and producing that power exclusive for a data center. And that is a great idea. These guys have the know-how. They have the energy, the natural gas to burn in those turbines. That's a great idea. I hope they really chase that down. It's a great idea the CEO has over at Chevron. These guys here, this is, for an older investor, not a bad idea and a good hedge on high oil prices. So Chevron's kind of keeping its value. I'm really glad about that. On a day like this, 0.41% isn't all that bad. It's actually really good compared to other stocks that are really selling off. Now, when I value Chevron, I come up with a 7% discount on their shares. Their cash flows are terrific and actually drives a really nice discount of 19%, but their earnings per share is down because of oil prices. And that, when I do the intrinsic value calculations, it is not up to its current stock level. Now, to introduce how I like to value companies, what I believe in, I've read books like Benjamin Graham's investor book. I follow Warren Buffett, Charlie Munger, and other investors. And discounted free cash flows is how I prefer to value companies. If you ask a lot of people, it's the most assured way of determining if a company is going to have great value. So I take the best information I have and create a cash forecast of what I expect that company is going to produce from free cash flow. And that's what you're seeing here. And then terminal values, all cash flows beyond year 4. And then I discount them just like we would discount a financial investment by a discount rate. And I get to a net present value of all those cash flows. That's the basis of my valuation. So when you look at this, that's my logic. It's from my MBA program where I studied finance, I studied accounting, but more importantly, I studied great investors that value stocks, and they've been very successful at it. And that's how I do it. So I get to the best forecast I can assemble, get a net present value, look at a per share level, compare it to the current share price. And right now, those cash flows are worth 19% more than the current share price. On earnings per share, it's easier, but some investors like Charlie Munger did not like this because management at a company can influence profits through earnings per share by taking charges or maybe not, and they can kind of influence the number. I like looking at it because especially with young businesses, it tells you how the business is growing, how they're growing profits. So I combine the two, but I take more weight in free cash flow method. 2/3 is the weight from this valuation. Be a great investment in my book. And therefore, I'm just holding my shares of Chevron. I own a position and I'm good with it. And I do like that income. So that is Chevron. All right. So it looks like we've got for algorithm. You agree on what I said on Micron? Excellent. Sufficient. Yep. Sufficient with Discord, and you have to be a paid member to be involved. Consider that. You go to the home page and look for the join button toward the bottom of the screen. You click on that join button, you'll see more details on how to get signed up. Thanks for tuning in. Appreciate it. So we went over the big oil companies, and let's keep moving on stocks here. And remember, I'd rather talk about what you want to talk about, and put those in the chat if you'd like. If you're a member, they are included. If you're not, the $5 chat. All right, so let's jump over to Amazon. Okay, so Amazon is under pressure, down 6.43. This is a huge cap company. That is a $2.33 trillion market cap company. So 6%, I mean, that's like 130, $140 billion of capital leaving the Amazon stock. Excellent. Thanks, Shadow Guy. Good to see you. So let's take a look at Amazon, and I'm going to go through each step of the valuation process on Amazon and update it. I haven't updated my valuation, so this will be an exercise we'll do together. Over the year to date, we are now in the red on Amazon. It had really sold off starting in February up until April, when a lot of stocks sold off in March and April, so it's not just Amazon. But the climb out of that sell-off wasn't as good as say, a Microsoft or even Meta, NVIDIA. They really climbed far faster. So Amazon was kind of getting there, but now with a big drop in its stock price, it's down in the red. Now, when we study their financials, let's take a look. What I really want to concentrate on. So overall revenue, trailing 12 months, 10.87. They actually did better in the quarter, 13% growth. And FYI, I thought that was really good because they're a giant business. In the quarter, they did $167 billion of sales. Annualize that, you're above 600 billion in revenue. You're growing 13%. That's gigantic. That's like, geez, that is 70 billion dollars of top line growth each year. It's like, oh man, that's like a big giant company. Every year they're adding to their enterprise. That is awesome. For a company that big to be growing that much is excellent. Now, the problem that Wall Street's having, and it's always been tough to do this with Amazon, is this cash flow. They are not afraid to invest in their business if they feel it's going to make their business better, more valuable. They're obsessed with their customer. They just want to be a greater company in the future. Therefore, their free cash flow just at times looks terrible, like it's looked for the last 2 quarters. In this quarter they just announced, they were barely cash positive. In the first quarter, they were negative, and that's because they're spending so much in that data center, buying GPUs, buying equipment, trying to keep up with the demand that's currently on the data center, with companies wanting to build AI, move workloads from on-premises over to the cloud, just all kinds of innovation there. So that makes it our jobs tougher as an investor. So we will take a look at Amazon and see how we should value the company. So I'm going to open a sheet on a screen you guys can't see, so that way I can look at the fundamentals of Amazon, and I'm going to open up the valuation sheet for Amazon. And FYI, see this valuation sheet, this is part of my research, and I open it up to members so they can have access to it. And that way, 24/7, they can take a look at my research. So if you become a member, you get to see all this stuff at any time. I have a sheet that I update, and you can see it. So before earnings were announced, I thought that the business, based on today's stock price, would have been discounted by about 3%. Now, earnings per share, I'm going to start with earnings per share. I usually go cash flows, but I really want to depend on earnings per share because I know that Amazon is investing in their future. It's not like they're spending cash on just dumb things. No, they're actually investing in that data center, which is a really good idea. They're making it bigger. The enterprise value is much larger. And when companies start using AWS cloud services, they're going to be there for a long time. So it's good that they're growing that business by 17.5%. All right, so earnings per share, let's update that and see what they're going to do there. Now, consensus on earnings per share for next year, 2026, is $7.42. Why am I going into next year? Is because we're on the second half, 2025, and really the way that we should think about the financials we're looking at is, as of today, looking forward, what is going to be that performance? So right now, it's better to take next year's number and use that. Maybe bring down the PE a little bit or the growth rate. Now, the PE on Amazon, they're growing 13% on a massive number, adding 70 billion or so of overall revenue to their P&L each year. That's incredible. So I think they're going to keep growing in that rate because the demand on that data center is so high. Now, when we look at the growth, the consensus growth that's expected by the market in 2026, 2027, they're actually going to keep growing their profits at a high rate. On average, they're going to grow them by about 19%. That is incredible. So we'll go with 19 there. So based on an earnings per share of $7.42, this is the intrinsic value formula, and a PE of 30, and a growth rate of 19%. And I'm going to bring that down to 15 just to play it a little bit conservative. The stock is discounted by 29%. Okay. Now, looking at free cash flows, this one's the tough one. Now, I had been taking the trailing 12 months and growing it by 15%. But we're in an investment cycle that Amazon has had for the last 2 quarters, a huge one. And they're probably going to be in it for maybe a couple more quarters or longer, depending on how much demand is being asked of their data center, of their data centers, I should say, their cloud business. So the best I could do is rationalize what would be a very good average. So let me bring you back to the numbers so you can follow my thinking. So we got, here's their financials. When we look at their free cash flows, right? You see that, and I think I'm in the quarterly, so I'm gonna get back to the annual. When they weren't like deploying capital into that data center, they were naturally doing about 32 billion of free cash flow. Okay, and they did that 2 consecutive years, and then they started putting a lot of capital into that data center, and you see that free cash flow really going down. That said, I'm expecting once they stop having to spend so much on that on the cloud business, the cloud business is going to have these great revenues, great profits, and start driving a lot of cash. I think they're going to do 32, and they're growing that data center by 17%. So what I'm going to do is I'm going to take 32, and I'm going to compound growth at 20% because I think they would drive higher cash flow than revenue growth, and then grow this number by compound it, 2 years at 20%. And that'll be my growth rate in that'll be my free cash flow in, let's call it 2026 or 2027. So that'll be my logic. And you see that investing is an art and a science. You can't just take numbers and put them into a calculator, because you may be putting in numbers that are not really representing the true future. I don't know that people would argue with me that Amazon is going to be a bigger business, a stronger business, and they're not one of the best companies in the world. I don't think many people are going to argue with me with that. Now, we can argue as to how we would value the company, and that's a really productive argument. But I think we could all agree that Amazon's far more valuable than a $13.4 billion free cash flow run rate, and they're going to do far more in 2 years once they have to stop spending so much capital in the data center. All right, so I'm going to take the trailing 12 months and go a little bit higher in following years, but for now it's 13,481 was the free cash flow for that year. But then here in year 2, I want this number to go up. Let's go 32 billion 878 times 20%, adding 20% to that number. And then once again, from here, we're going to go 30%. Yeah, that's pretty good there. So we'll get back to a more natural free cash flow number, and then they'll really start cranking up their cash flow. So this is a forecast that I think is going to be achieved by Amazon, because this year they're putting so much capital into that data center, but that's not a permanent thing. It's not like the business is going to need it every single year. Once they have all that GPU infrastructure in, it could be used for 5-10 years. Having said that, the deployment of capital is temporary. So I like this forecast. Once we forecast along those lines, and I think they're going to continue to grow those high rates, and I discount by 8%, we get an intrinsic value of 2.5 trillion. Now we got to update cash and debt, because I like to add cash and take away debt. You think about some businesses, they have high cash flow, but they have high debt. Well, that debt will have to be paid by somebody. And I like to deduct it, decrement it from their overall valuation. They have $93,180 million of cash and they have taken on some debt, probably to fund all those data centers. So they are discounted by 7%. If I look at the best forecast I can put together for cash flow, that is where they land. So we just valued a company together, and I am comfortable saying that I think it's discounted by about 15%. I think Amazon's one of the most important businesses in the world. I think they're going to be a $1 trillion revenue company in some day. I showed you their growth rate. And I will be buying shares of Amazon. I think it's a good opportunity. I think the market is having a little bit of a panic attack over this drop in free cash flows. Okay, that could be a problem. And you know what I didn't do? I got to do a cloud business compare. I meant to do that. I think it'd be interesting to go this far and say, okay, so what is going on? And I'm not quite sure what's going on here. So let's see if I can clear out. One second to get my formatting right. All right, cloud business compare. So we're going to have AWS is Amazon. And I don't know why Sheets is sometimes kind of funky. It changes the font color to black when everything else is white. But what are you going to do? And then we've got Microsoft Azure, and then we have Google Cloud. And I think it's GCP is their acronym. So I'm going to compare revenue, and we're going to compare a growth percentage, and then we're going to compare, we're going to say share just between the three of them. I'm not going to go like, hey, let's look at all market share of the entire market. No, I just want to look at just between the three companies. So AWS, let me take a peek at their financials. We'll look at that together. Then we'll look at Azure, and we'll look at GCP. So they grew their cloud business 17.5%. Very good. Okay, and I think they had their number here. Net sales increased. So they increased this to year over year. So their cloud business is 30.9 billion for the quarter. Okay. So if I multiply that times 4, I get their total revenue. Okay. So 30.9, and we multiply that times 4. All right. And I'm going to put a comma on that. And the growth rate was 17.5. And we want to change that to percentage. All right, and I'll do the share later. So let's go over, I'm going to go over to Microsoft Azure now and see what was their cloud business. So Microsoft Investor Relations, hopefully we can get to that information quickly. I think we will. And FYI, everybody in the chat, if you guys see, if I missed anything on these companies, please put it out there. I have no ego. If I miss something, I want to be corrected, please. And it looks like I've got good comments coming in. Awesome, Adam, great to see you. You're a new member. Thanks for joining. I'm going to read your comment in probably about 10 minutes. Sebastian, awesome to see you. Tony, what's up, my man, Tony? Justin, I see your super chat. We're going to do a deep dive on Zeta. Bear with me. I'm going to continue on Amazon. We're doing a deep dive, full analysis of Amazon. We're checking out the cloud business, comparing it to Microsoft and then Google. All right, business highlights. So here's the cloud business. So 29.9 billion, and this increased by 26%. See, I think this is what the market's kind of having a little bit of a heart attack over. Geez, that looks really good. So 29.9 billion. Wow, that's good. So, and they grew at 26%. This was 26%. And that growth rate is another thing that the market's kind of having a heart attack over. It's like, guys, why is Microsoft catching up to you? All right. So now let's look at GCP. Man, we are going deep. But that's what you got to do, man. You got to know your businesses so that you can make sound investments, make lots of money over time, and enjoy the rigor, enjoy the passion, getting into these numbers, getting your hands dirty. You know, when I was a kid, my older brothers used to like working on cars, and I did too. And I remember being a 11, 12-year-old, and they used to let me turn wrenches, and we'd get all greased up. I thought it was the funnest thing ever. Well, it's a little bit of that. Let's get all greased up. So Google Cloud increased 32%, 13.6 billion. So smaller business, 32%, 13.6. Okay. Okay, so now for the share. It's going to be a quick calculation of this number divided by this number plus this number plus this number. And I'm not going to have it auto do it because it's probably going to get it wrong. And then we'll hit this guy with a percentage. So our friends at Amazon are controlling 41%. Between the three of these guys, the three big guys, they're controlling 41%. I'm going to tweak something here, and that's M2. Yeah, so I want that. That's fine. But I needed to keep these the same. So if you put a dollar sign, then that portion of the formula is not going to change. In this case, the row. So this is what the market's having a little bit of a uh-oh moment. And that's why Microsoft stock is rallying and AWS, Amazon stock is under pressure. Microsoft's pretty much caught up and they're growing faster. Uh-oh. That's an uh-oh moment. That, you know, avoiding the ego trip of who's number one and who's number two. This is an awesome business, and having more than $100 billion of cloud revenues is phenomenal. And Google Cloud's growing really fast too. That looks good. They're trailing both of the big guys. But again, removing the ego trip, having a $54 billion business that is in cloud is phenomenal. So that is interesting to know. Does that change my feeling? It does a little bit. I have greater respect for Microsoft. I'm like, man, Microsoft is getting it done. And I'm cool with Amazon. I'm like, okay, that's fine. You just got to keep growing, keep getting bigger. Amazon also has other businesses too, but I'm glad we went through that exercise. I like putting facts, on the on my analysis versus just constantly following the stories that could be true. They could be absolutely true, but I like to kind of form my own conclusions and try to form them based on, facts. Like, hey, that's what's going on. Here are the numbers. So here are the numbers we came up with just to go through them. That's a little bit bigger. So AWS 123, Azure from Microsoft is at 119, and GCP at 54. So they're slicing up this business quite well, and the growth rate, I think, is what's making investors uneasy of Amazon, saying, "Hey guys, what's going on? You got to start growing better." So, and then on a valuation, let's take a look at the valuation to summarize, and then we'll move on to that super chat request. So Amazon, I think, is discounted by 16%. I think their cash flows will rebound. I created a unique cash forecast, and if you remember, you'll be able to get this. I'll go ahead and update the sheet that has the valuations this weekend, so you have access to this. And I am open to questions, objections, chatter. I think we're not going to argue about Amazon being a great business. They are a great business. Okay, that one's kind of like 99% of the population of investors is going to say, yeah, I agree with that. How we value them, that's where we can have a very good conversation, where if we have different ways of arriving at a conclusion, it's productive for us to listen. Mine's formed on some of the principles of long-term investing, looking at cash flows, discounting those cash flows, because that's what companies represent, the future expectation of cash flows, and looking at their profits as well. Awesome. That was fun, guys. Let's get into Zeta. Justin, thank you so much for the super chat. And let's see here. I'm going to catch up on comments, and we're going to hit Zeta. Zeta is next. Man, I got more. I feel a little bit like my 20-year-old son. He opens like 100 tabs, and I'm like, why don't you close some of your tabs? And he looks at me like with a blank face, like, you don't get it, old man. And he's going to keep doing what he does. All right, so open up. I want to keep that one active. So we're going to go to Zeta, set that up, and we're going to do a deep dive. We're going to get all over this business. Let me check in on the chat, super chat. So Justin, thanks for the Reddit recommendation about a month ago. Yeah, Reddit, to me, a month or a couple months ago, it was one of those, it's obviously a very good business. It's like, they're different. They're not like Facebook. They're not like, Instagram or other places. People go to Reddit to have deep engagement on a particular topic, and I think that's really, really valuable for advertisers, because advertisers can really advertise precisely to people that are genuinely interested in a topic, and their growth rate is phenomenal. They increased their growth this quarter. So we're going to look at Reddit at some point in this live stream. That was a really positive earnings. My only regret is I didn't buy enough stock. And we can definitely look at MU. Sebastian. Yeah. So you want to look at Reddit? I want to look at Reddit, Sebastian. We look at Reddit after we look at Zeta. Shadow Guy. Yeah, I don't have XOM. I don't have Exxon, but I have Chevron. Um, but if you wanted me to check out, Exxon, I could do a valuation. Why don't we, if we have time, we can crank that through, or I can do it on my after hours and get that over. Adam, currently quite down on my healthcare picks. Yeah, healthcare has just been getting destroyed. What I'm doing with healthcare, it's a little bit of, it seems to be super discounted, but the market just is not giving healthcare many breaks. Today, healthcare is up a little bit, by the way, but at what point will we see that healthcare is going to begin to have an upward rally? Maybe today is the beginning of something, but it's hard to tell, right? It's one day. Maybe after a week of seeing some green over here while everything else is red, then we could say, hey, it's probably a good time to buy into healthcare. So for sure, pharmacy, well, maybe I shouldn't have so much money in Nvidia or Google or Meta or Amazon, and maybe I could rotate into healthcare because these guys have good growth rates, great gross margins, great cash flow, and so forth. I'm I'm okay being a little late, but I just been seeing so much. The worst situation Nordisk is just getting slammed. It's amazing how hard that stock is getting, sold off. So I'm just waiting for the market to show me, this is one day, maybe after a week or two or three of showing more green more often than anywhere else, then I would say, okay, I'm going to go ahead and buy, because healthcare is so discounted. Even if the stocks rallied for a week, I'm still going to make lots of money. But I just don't want to lose money by chasing something down and trying to find the bottom with the rest of the market. So that's my point of view, my research on healthcare. All right, I think I'm caught up. Good stuff, guys. You guys tuning in. We're 64 strong stream. Need my tabs. Tony, you and my son, man, he'll have like 100. He has these big monitors. I'm like, how do you organize that? But he does, and you do, Tony. So you keep at it, buddy. All right, so we've got Zeta Global. This is a $3 billion business. Zeta Global Holdings Corp operates an omni-channel data-driven cloud platform that provides enterprises with consumer intelligence and marketing information software in the US and internationally. Company's Zeta marketing platform analyzes billions of structured and unstructured data signals to predict consumer intent by leveraging machine learning algorithms and the industry's opt-in data set for omni-channel marketing. Okay, this is like AppLovin and another company we've gone over, which is called Viant. Viant doesn't have a $3.5 billion market cap. It's like 1 billion. AppLovin's above 100 billion. This is a really neat little business to take a look at. It's down 17% over the 1 year. It's down 30%. Okay, so revenue is 1 billion. So you're paying like 3.5 times revenue. That looks pretty good. Analysts think it's really discounted. Okay. Forward P, they're not profitable. That's okay. We can work around that. We can, again, investing is an art and a science. If we think they're going to hit profitability next year, or their free cash flow is going to start really driving up in a year or two, we can create a forecast based on those those expectations. Okay, so they're growing nicely, 40% growth. That looks really good. Now let's look at gross margins. On a newer business, gross margin is really important. And I'm going to get to the gross margins, and I think they're going to be around 60%. A couple of things around gross margins. Why are gross margins important? On a small business, if they show high gross margins, I expect when they get to be a bigger business, those margins are going to expand because you have to keep buying these, expensive, maybe servers for them, server technologies over and over and over again, and you can just run a bigger business on the same cost of operating that business. So economies of scale come into the picture. For them, they've been around 60% and a little bit higher in previous years. Right, they're losing money. That's okay, and it'd be better for them to be profitable. When I say it's okay, it's that I'm willing to, work with a company that is going to show free cash flow. So I really like this. Okay, let's show the chart. When you have a company, or really any data set, if you have a data set that shows a smooth growth pattern like this, okay, for me, I'm confident, meaning I'm confident that I could trend this and set an expectation that is going to be met. Now, if you have a data set, in this case here, free cash flows, that's all over the place. It went up to 2 and came down to negative 500 million, up and down and all over the place. It's really hard to say, well, what's going to happen next? But this company, I really like their data around free cash flow. It shows that, hey, they're growing it. They're growing nice and smooth. In fact, from 2023 to 2024, they grew by $38 million. And if we were to do a percentage on that, that'd be like 55% growth. Excellent. On the trailing 12 months, that just includes one quarter. It's grown substantially, like 13 billion, excuse me, and that's just over one quarter. So just in one new quarter in that trailing 12 months. So that looks really good. Okay. So we're going to build our valuation based on this, and there's probably a consensus of what the earnings per share for 2026 is going to be. So we have data to do a valuation. Take a look at a couple other things that are important. So I like their growth. Let me look at their website just to kind of get my head around who they are. These guys are located in New York. And of course, every company is putting AI into their marketing message. Even the platform doesn't use a ton of AI. Hey, let's just say we use AI. All right. Look good. Okay. Just getting familiar with their website. So they do the marketing platform. They want to set up agents that can maybe track certain data and then be able to market based on what they're seeing. Okay. Okay. This looks like a business similar to AppLovin. And AppLovin's a good company. These guys are, from what I know, these guys are the biggest market cap in companies like this, right? So when you look at what they're doing similar things. They're looking at users across different media platforms, like YouTube, Instagram, Facebook, Reddit, and helping companies advertise, get the best return on investment advertising. That company and this company are similar. So we can kind of compare the AppLovin business versus this business. AppLovin's far larger, but it's a good compare because AppLovin's above 100 billion in market cap, which is good. It'd be good to compare this smaller business to that business to see, can they someday get 100 billion in the market cap? I know investors would be very happy if that was the case because their investment would go up by like, geez, 25 times, and that would be excellent. Okay, so let's check a few more things. Forecast. So 14 analysts cover this stock, and there are some very optimistic analysts. One analyst at 45. Average analysts say the stock's worth $28.50. And the scenario is you're going to hold on to your investment. Stock down. Looking at consensus like for their growth this year, looks like they're probably going to grow about 26%, and then they're going to keep growing. Their growth is going to slow down, but they'll be a $2 billion revenue company in 3 years. Their earnings per share, 69 cents per share this year, and then next year, 88. Okay, and it's growing by 19 and 11, so I'll grow it by like 14% growth. Okay. All right, so I am going to look at a lot of that data we just looked at on another screen. Before I do that, let's just take their balance sheet, just look, just make sure they don't have like a gazillion dollars of debt. They don't. They have more cash than they do debt. They have $364 million of cash, less the $207 million of debt. So they have a net cash position of $150 million. Very good balance sheet. Very good. Okay, so let's get cracking on a valuation. So I think I have AppLovin in here, and I do. So we can do that. And here's AppLovin. They're bigger, but similar business. And Viant is in here as well. What I'm basically doing here, and you get a copy of this model if you're a member, and you can do your own valuations. You can take my sheet, copy it, tweak it, make it your own, and start forming your own research. Okay, so we've got Zeta is a smaller business. So AppLovin is a bigger business, well-known, great balance sheet, all kinds of good stuff. This one's a smaller business. So good balance sheet, but I'm still going to go to a 9% discount rate. As you increase the discount rate, you would earn a greater return because you're taking a bigger risk, but it would make numbers smaller. Like as you discount free cash flows, it'll make the intrinsic value smaller. Okay, so looking back at the trailing 12 months, these guys were doing well. And let me look up that information we just saw, and then I can start forming a cash forecast. So they're at 121.34 million. And last year they grew from 2023 to 2024 by 55%. So they're trending really, really well. So I'm going to grow by 35% in this year. And They're going to be a $2 billion market revenue company in 3 years. They're basically going to be twice as big from a revenue standpoint. So we'll grow longer term cash flows by 30%. Okay. So those are numbers that I think apply given their size, their growth rate, and then long-term growth rate at 5%. Typically that's 3 to 4, but since they're small, they're in a pretty fertile market. No one's going to stop marketing the way they market to all these social apps and Netflix, Amazon Prime. And if anything, we're increasing. And so those are numbers that I believe in. The intrinsic value is very high. Now let's take a look at cash. We're going to add cash and take away debt. So when we look at their cash position is 364 million, 0.4. And we got 207 million, 0.92. And I got to update their share count because that share count is not correct and it's driving some numbers that are not correct. They have $235 million shares outstanding. So this stock, based on this cash forecast, the value of all that cash is 6.9 billion. Added cash, took away debt, we get to an equity value of 7 billion. The market cap's 3.5. They're discounted by 50% if we look at the value based on cash flows. And I really like this business. I like their growth. I like where they're located. Meaning I like the industry they're operating in. Now let's take a peek at earnings per share. So earnings per share was 88 cents per share looking at 2026. They're growing really nice. 36, yeah, that's fine. And that's a 36 that I was using on App Lovin'. And these guys are growing nicely like that. So it will go to 32. Growth rate on that, I wanted to go 14, which is a decent number. So yeah, this is discounted. This looks good. Now, when would be a perfect time, right? There's never a perfect time, but let's just see what's going on with RSI. This stock is slightly oversold, like slightly, right? RSI is 48. So if we look at how has this stock been trading, right now we're on a sell-off. Small caps tend to get sold off. It's just irrational, like sell it. I want to get out of stocks. I'm scared is how the market reacts. So 4%. Year to date, this one's down 17. Why are they down? They're growing. They're on a path to cash flow. Is there negative stories around this? I think it was Justin. Do you know if Zeta has some negative stories? Like, are they being sued? Are they in trouble? Is there something out there? Not a lot of news there. Why are they selling off? So, valuation. So I'm looking at the stories, guys, seeing, is there some negative stuff out there? No, nothing yet. Last thing. Let me take a look at the short sales. Short seller, excuse me. Wow, man, this stock is being shorted. So their stock was being shorted even worse or at a higher rate last month, and it's come down to 12.26. The shorts are getting out of the stock. That's good, but it's still being shorted by 12.26. I don't view that as bad. I based on valuations. I base my decision on valuations. And if anything, if this stock starts to rally, it's going to force these short sellers to buy the stock, and it's just going to kind of turbocharge a rally. So overall, I'm seeing a lot of good things here. I really like what I'm seeing. This one here is discounted, good looking company in the right space, good acquisition target. I think another company can come in and swoop them up, offer 5 billion, 6 billion, 7 billion, and then have an additional $1 billion of revenue in their business that is going to be profitable next year. And they're going to have earnings on Tuesday. Whew. Man, this is a good looking stock. The other thing I like is their size. At 3.5 billion, these guys can double in value like in no time. They could quadruple and still kind of be flying under the radar. So their size and their success, to me, is very attractive. So Zeta is a real good looking company. I'm going to put that one and put it on my watch list. That is a stock that I need to keep an eye on. And I'm in a slow period of buying, but man, I can't ignore when value knocks on my door and it says, hey, I got this business growing at 40%, cash positive, going to be profitable. I got to at least do what they have to say. So good one, Justin. If you found 10 companies like this, I just venture to guess that 7 or 8 of them are going to be good investments. 2 to 3 of them are going to be fantastic. Like, bam, you just 10x your 2 years. So you're on the right track. You found a company that was growing revenues. You found a company that had free cash flows. You found a very good balance sheet. They're in a good industry. They have good margins, not fantastic margins, good, but they're not like 30%. They're 60%. Hopefully they can move it to 70. They're small cap, but not tiny cap. Like 3.5 is pretty good size cap. So this one's I think we hit pay dirt on this one. So nice work finding it. Hopefully my analysis was interesting. And yep. So and if you want to look at the valuation, you can come back and view the video again because I'm leaving it on the screen for a while. If you sign up to the channel, this will be with the sheet that I'm going to upload. So then all investors that are members will have access to. You'll have access to the full sheet so you can see the calculations. You also have access to this model so you can copy and do what you. Nice work, Justin. Man, that's a good one. Now we're in a sell-off, right? And these sell-offs, you see that the big caps like NVIDIA, it's only down 1.7. Google's down 1.7. But these small caps, the market just unleashes a lot of selling because small means lesser known, riskier. Remember how I used a higher discount rate? So these tend to sell disproportionately more. So it creates a better opportunity. But we need to know when to buy, right? This one's been up. It makes me cautious. Like, why the heck's it been selling off? And it's not like it just sold off for a little bit. Let's do this. I think this will be good. Let's compare it to App11, which is kind of, I'm going to call it the gold standard within their industry. See how over the 1 year, App11's killing it, up 400%. So they're going in opposite directions to App11. Why? App11's great. I can tell you firsthand, App11's great. But the fundamentals that I see in Zeta are similar to App11. Smaller, that's okay. Their market cap's smaller. And there's something, I feel like there's something there. Why are investors not buying into this? They bought into App11. And today, App11's down 2.7. These guys are down 4.6. Over the 1 month, AppLovin's up. This one's down a little bit. Year to date, AppLovin's up. This one's down. So they were tracking with AppLovin a little bit, and then they become separated. So if there's no negative news on Zeta, I mean, it's kind of like I would pick a good spot and go with it. So, all right, good one. Very good one. Nice work. All right, so we needed to cover a couple more here, and then I'll call it a day. So we're going to look at Reddit, and then we're going to look at Micron, and I think that's all the time that I have. All right, so Reddit, go Reddit. So we looked at Reddit yesterday on the live stream, and the numbers look fantastic. And today they're up 20.96. Nice applause. Nice job, Reddit. And this is when I said, man, this is obviously a great company. This is obviously a market that is overselling a stock. Sometimes the market is irrational, and that sometimes I would maybe change to often the market's irrational. Reddit, in my opinion, is a successful recipe for a company that's going to be big, viable in the future. I just think their business separates itself from everything else. It has a lot of loyalty, just all the good stuff. And the market said, whatever, I'm selling it. I'm selling it by 61% off. Well, guys like me are like, I did the valuations. I think it's discounted. And I started to call it out like, this is obviously a pretty good opportunity here. And we are up 123%. So the market, when you have these sell-offs, see the opportunity play out. You have a prolonged sell-off. It takes quality businesses and just puts them out with the trash. And let's say I was in my neighborhood walking around and somebody put like a beautiful mountain bike next to their trash can and they put a sign on it, free. I'd be like, yeah, I'll take that mountain bike. Thank you. That's never happened to me, but maybe someday. But it's kind of like that, where 61%, wow, that's really good because their fundamentals are good and they're growing. So now today, man, nicely done, Reddit. 21%. Nice. Why didn't I buy more Reddit stock? I didn't buy enough. $35.8 billion market cap, revenue 1.67. They're profitable. PE is only 166. Ha ha ha. That's a high PE. Now they're priced a little too high. So when we look at the quarterly, they are accelerating their revenue growth from last quarter. I think that's why the market's having a party on Reddit. So that looks great. Nice job, Reddit. Free cash flow, 396. See, these businesses, let's go look at these gross margins. Back to gross margins. Gross margins are really important for small companies because they show you that they're just going to keep a lot of that in profit and cash. And Reddit's a perfect example. They are going to crank out cash. Meta, which was Facebook before, same thing. That's why Facebook Meta is worth almost $2 trillion now. So that looks fantastic. 396 free cash flow. Nicely done, Reddit. I'm going to make a quick note here. And their top line growth was superb. Now they're running at 70% growth rate. When we look at their cash to debt, they have $2 billion of cash and only $25 million of debt. So they have pretty much no debt. But $2 billion just laying around, just buy back shares, acquire another business, fund their growth. It's all there. Very good. That looks fantastic. Looking at their RSI, they are severely, well, not severely, but they're overbought. They're 80. No big surprise. When the stock's up 20.68%, yeah, the RSI is going to move. Analysts, 26 of them. The analyst sets at $67 price target is probably going to take the day off and rethink his valuation of Reddit and say, whoa, how come I'm that far off? The guy who has a price target at 230 is like, see, I told you guys, I told you, Reddit's a really good stock. And on average, 163. This stock has moved nicely in the last couple, as I showed you, from the trough to the peak, 123. But even recently, it's just been cranking. And look at the 5-day. It was moving up. I saw it moving. I'm like, what's going on, Reddit? What's going on? And maybe some people were smelling that, hey, they're going to have a good earnings. And then shazam, they're up 36% in the last 5 days. Nicely done. Okay. So that looks good. What's their earnings per share going to be? How are they going to grow? So their growth, I think they're going to exceed this number because their trailing 12 months is 70%. Their last quarter, they grew at 72. So I think it's going to be better than that. They're going to keep growing at high rates to be a $3 billion company in 2 years. That looks great. The earnings per share for next year is $2.32. And I think it's going to grow. Growth rate will be real nice. They're going to grow from this year to next 83% and then 38% from 26 to 27. Awesome. Nicely done, Reddit. Okay. So here's the valuation I have on Reddit. So I was taking trailing 12 months, growing it by 40%. That looks good. The trailing 12 months number has expanded to 396.85. Now I'm going to lighten up on the growth on years 2, 3, and 4. Grow up 5%, that's fine. Weighted average cost of capital, we'll leave it at 8. This is the discount rate. Okay, and then they have $2 billion, $60 million, and they have a tiny bit of debt. Shares outstanding. Let's see if their share count changed. Shares outstanding, 184.52. Yeah, it's the same. Okay. So right now, Reddit's priced 5% too high, judging from the cash forecast I'm putting in there. So they're fairly priced on cash. Earnings per share is going to be $2.32. Growth rate of 48. And then I want to grow that by 40%. So based on earnings per share, they're priced 19% too high. So overall priced 10% too high. Not a big surprise because the stock's moving so fast, but that's where my valuation takes me. Now, could I see Reddit give up some of these gains? Yeah, because I mean, it's moved so fast that, okay, great. Glad I bought some shares. But I can say on that, if it sells off like it did before, I'm going to buy a lot more shares than I did this time. It's moved really fast. Okay. If it were to have a pullback, I'd probably start buying right at fair value and see where it takes me. But Reddit's been a real good winner. This was clearly an opportunity a couple months ago. Today, it's having a joyous day. Just killed their earnings, just destroyed expectations. So nicely done, Reddit. And I expect they're just going to keep doing well. All right, Reddit. Nice. Yeah, Tony. Reddit. All right. So let's do Micron, and then we will wrap things up. So Micron is a semiconductor company. They're down 3% year to date. They are up 25%. But you see this now. This volatility everybody had, but let me go out a little more. See this volatility. The market's a little unsure about them. Okay, why is the market unsure about Micron? Well, I have a theory, and my theory. So this is a $117 billion market cap. It's 33. PE is 19. Where other semiconductors have these crazy PEs. And these guys are growing at 58%. Wow, great growth. But as we look at their margins, especially 37%. Last year, or excuse me, that's on the trailing 12 months. 2024, the margins were 22. See how their margins have just been up and down. They have competition in their space. And this is big competition. Samsung's one of their competitors, and then this Chinese company. The type of business these guys are, they do memory and storage that's immediately available to the GPU, CPU. So it's important, but it's a commodity. There's no uniqueness to it. Samsung's storage and memory can do the same thing that Micron can do, and they have I think it's called Hymix is the other competitor. So they have competition, which keeps margins down. And that's what is the difference between a Micron and a Broadcom or an NVIDIA. So I think that's what keeps this stock down. Okay. The growth rate's really good. The other thing too is it expected that they're going to keep that growth rate going? No. Semiconductor tend to be cyclical. So that's where the market will have a good year and then a bad year. Now, analysts are pretty positive on the stock. They're saying it can go up 44.8. So there's some enthusiasm around this stock. We're in the year that's going to end soon. And then the year that's going to begin on, I guess, August 30th is going to grow nicely. But you see, here's the cyclical nature of their business. They have periods when revenues go down, revenues go up, revenues go down, revenues go up, revenues go down. We've had an build out of that data center, but you're seeing that it's going to slow down at some point. Earnings per share is expanding nicely, 12.59. Nice growth, but then it's going to slow down. Okay. So this one here, let me see if I don't know that I have a valuation on Micron. I don't. So I've valued Micron in the past, and it just doesn't drive a good valuation. Let me look at their cash flow. So their cash flow, you see how remember how I had that comment about Zeta, that I liked how smooth their data was. It just showed that nice. This one, not much. You got data all over the place. This one's harder well, what's going to happen next? I don't know. They have years it goes up, years when it goes down, years when it's negative. Trailing 12 months, 1.8 billion. A business at their margin level with good growth that I'm seeing, I'd be a buyer of this stock at like 30 times free cash flow. 30 times free cash flow is going to put us at like $54 billion in market cap. And these guys are way up at 117. So I'd have these guys priced like more than 50% too high is what I would end up with on a valuation for Micron, which is why I haven't really kept them around. I just feel like, you know, they certainly are not a NVIDIA. NVIDIA is expensive, but you can look at the attributes that made them this valuable. High growth, margins, high margins, okay? Cash flow. Look at that smoothness to the data. Upward growth on cash flow. NVIDIA's once every 20 years, 25 years, you get a stock like this, and NVIDIA's it. It's really, really good looking stock. But you can see the difference in margins, cash flow, consistency in cash flow. The revenue is growing better. I was able to catch A-Lab, which is similar to NVIDIA. They're really small compared to NVIDIA, but I'm doing well with A-Lab, and I'm glad I bought it. All right, guys, so that's all the time I have. Boy, was that a fun stream. It's good to see some friends. Tony, great to see you. Have a nice weekend. And Justin, thanks again for bringing Zeta to the stream. Good one. David, good to see you, man. You're not looking at the market. That's one way to avoid the carnage or the pain. And Sebastian, great to see you, man. Thanks for tuning in. Let's enjoy the update on Reddit for sure. Shadow Guy, thanks. If you want me to look at Exxon Mobil, Shadow Guy, glad to do it. Shoot me a Discord message and I can add that guy. Adam, great to see you. Let's see when healthcare is going to have a long-term rally. Sufficient for algorithm. Brandon, thanks so much for joining. Braden, good to see you. Doomy Trash, good to see you. All right, guys. Well, it is what it is. We have a red day. Let's not get greedy. We were in a very good market from April 9th to call it 2 weeks ago. We were on this just rally that wouldn't stop. And now we're taking a little medicine. Hey, you know what? Maybe prices were a little too high. Maybe expectations were a little bit too high. And we're seeing some stocks give up some gains. Amazon is looking like, I think it's overly done. I'm probably going to buy some shares. I'm probably going to buy some shares in Meta and Google. And I'll see what else. I'm going to sit back and enjoy Reddit's gains. And what was A-Lab doing today? I think A-Lab was giving up some of its gains. Yeah, I'll probably buy some A-Lab today. What else? All right, so everybody, thanks for tuning in. Awesome stream. You guys enjoy the day as much as this is a good day to go out golfing, go for a hike. Not a great day to watch the market too much because it could be pretty depressing. And hopefully next week we're like, hey, we're on a different trend and we'll see what happens. But remember, as markets sell off, it creates an opportunity for the investor that's prepared. Thanks so much, everyone. Have a terrific weekend. I appreciate your time. We'll see you guys.